If your aim is to achieve financial prosperity while leading a content, uncomplicated life, with the assurance that your investments are actively working for you even during your restful moments, then this video is tailored for you. Conversely, if your objective entails dedicating countless hours each month to agonizing over stock selections and perpetually monitoring their performance to avert losses, then this approach is unequivocally not suited for you. The concept of employing merely 3 ETFs might appear deceptively simple, almost too good to be true. However, after years of personal experience, I can attest that this 3 ETF portfolio has outperformed any alternative I've encountered and consistently surpassed the performance of the stock market on its own. You may have heard of the 3-fund portfolio before, likely the outdated version originating from the 1990s. Regrettably, many still adhere to that model, unknowingly depriving their portfolios of substantial growth potential. Transitioning at least 2 of the funds to the more contemporary version, which aligns better with current market dynamics in 2024, presents the most prudent course of action. It's evident that investing is the pathway to achieving financial independence. While saving $500 per month for 20 years would yield approximately $120,000, investing the same amount monthly in the outdated 3-fund portfolio could potentially amass around $250,000. However, with the new portfolio strategy I'll discuss today, boasting an average return of 133% over the past decade, your investment could balloon to nearly $500,000, double the amount simply by selecting the right funds. The challenge often lies in the perception that saving money is straightforward while investing appears dauntingly complex. This channel was created precisely to demystify investing, and as a university professor, I firmly believe that this knowledge can be imparted without unnecessary complexity. I'll provide comprehensive insights into the 3 ETF portfolio and detail my own investment allocation percentages to guide you in optimizing your portfolio. Above all, my overarching objective has always been to attain time freedom, affording the flexibility to pursue my passions and activities on my own terms, rather than being tethered to employment. If this resonates with you, then exploring investments in ETFs may align with your aspirations. ETFs function as a streamlined approach to investing, akin to a cheat code. Rather than grappling with the complexities of identifying the optimal companies to invest in or timing stock sales amidst market downturns, ETFs streamline the process. Essentially, an ETF operates as a composite fund comprising a selection of top-performing companies. When you invest in an ETF, you gain exposure to a diversified portfolio of companies. For instance, the View ETF, which mirrors the S&P 500, offers investment opportunities in 500 prominent companies such as Apple, Microsoft, Nvidia, Amazon, Google, and Tesla, among others. With just one share of this ETF, you gain access to a basket of elite companies. Within each category of the 3 ETF portfolio, I'll present several options for consideration. It's imperative to conduct your own research to determine which ETF aligns best with your investment strategy. Relying solely on one individual's recommendation, even that of a professor, is not advisable. However, the ETFs discussed in this video have undergone rigorous vetting through extensive research, providing a solid starting point for further exploration. Before delving into the 3-fund portfolio, there are 3 fundamental principles to grasp. Firstly, simplicity is key. Begin by selecting one ETF from each category to streamline your investment approach and maximize returns. Secondly, establish your investment goals and motivations. This aspect will be revisited when discussing portfolio percentage allocations, ensuring alignment with your objectives. Lastly, consistency and resilience are paramount. Market fluctuations are inevitable, accompanied by both favorable and adverse news cycles. However, steadfast adherence to your investment strategy without succumbing to reactionary impulses is crucial for long-term success and capitalizing on compound interest. While the traditional 3-fund portfolio served its purpose in the 1990s, technological advancements and evolving business landscapes necessitate an updated approach. The new 3-fund portfolio, tailored for 2024, surpasses its predecessor in efficacy and relevance. The Foundational ETF, the cornerstone of the portfolio, remains consistent with the original 3-fund model. This component prioritizes safety and consistency, boasting a robust historical track record. Investing in a reputable ETF with a proven history and maintaining a long-term commitment is a fundamental strategy employed by successful investors. This particular type of ETF has demonstrated resilience through various economic challenges such as recessions and significant financial downturns, rebounding to achieve record highs and excel consistently. From 1950 to 2022, the S&P 500 exhibited positive returns in 74% of one-year holding periods, illustrating that holding an investment in the S&P 500 for a year typically resulted in favorable returns 3/4 of the time. Moreover, the probability of success increases with longer holding periods. Returns were positive in 83% of 5-year holding periods, 92% of 10-year holding periods, and 100% of 20-year investments. In essence, holding an investment in the S&P 500 for any 20-year period has historically yielded positive returns without fail. Considered a foundational ETF, this investment option is analogous to constructing a sturdy house with a solid foundation. No matter how high quality the building materials or how appealing the interior may be, a shaky foundation risks compromising the entire structure during adverse conditions akin to a storm. Within the foundational category, two notable options stand out. ETFs tracking either the S&P 500, such as VU or VTI from Vanguard, or those following the Total stock market. Various ETFs from different providers track these indexes, offering flexibility for investors to select alternatives aligned with their preferences or explore mutual funds that mirror these indexes. A comprehensive analysis of different ETFs and index funds tracking the S&P 500, including their advantages and disadvantages, is available in a linked video. Moving on to the second category, this ETF prioritizes safety while generating consistent cash flow through substantial quarterly dividends, potentially enabling investors to sustain themselves without tapping into their principal investments and leaving a legacy for future generations. Traditionally, the old three-fund portfolio advocated for safety through bonds, which offer stability and dividends. However, the downside lies in the minimal upside potential, with bond ETFs averaging a 10-year return of 16% annually, often falling below inflation rates and even yielding negative returns over shorter periods. The new three-fund portfolio, however, shifts this paradigm by investing in dividend ETFs with a robust decade-long track record of consistent dividend growth. Among the preferred choices for this category are VIM from Vanguard and SHT from Schwab. While numerous dividend ETFs boast higher dividend yields, the emphasis here is on broad diversification and utmost safety, avoiding ETFs with excessively high yields that may lack long-term viability. My top choice here is SHT, the Schwab's Dividend ETF, for several compelling reasons. Not only does it exhibit consistent overall share price growth, but it also demonstrates an annual increase in dividends. Consequently, investing in this dividend ETF not only yields rising share prices, but also boosts dividends over time. Contrast this with the old option, the BND ETF, which represents a bond ETF with a meager 10-year average return of 16%. If one were to invest $50,000 in BND today, it would grow to $58,000 in 10 years and $88,000 in 20 years, an unimpressive outcome. In contrast, choosing SHT with its 10-year average return of 11.5%, could potentially grow the same $50,000 investment to approximately $150,000 in a decade. Moreover, SHT offers a dividend yield of around 3.5%. For instance, if an investor accumulates $500,000 in SHT over time, they could receive an annual dividend of $17,500, translating to roughly $1,500 per month in passive income while their investment continues to appreciate. One of the primary rationales behind investing in SHT or similar value-oriented dividend ETFs lies in the composition of the underlying holdings. These companies, while not necessarily flashy or trendy, provide essential goods and services, offering stability and resilience. By diversifying into these sectors, particularly amid the prevailing tech-heavy market landscape dominated by technology, AI, and semiconductors, investors can fortify their portfolios and mitigate risk. SHT's portfolio includes stalwart companies such as Broadcom, Home Depot, Chevron, and Coca-Cola establishments with enduring demand. The fund maintains a well-balanced allocation across various sectors encompassing industrials, financials, healthcare, information technology, and consumer staples. Although this category demands a long-term perspective, investors stand to reap substantial rewards by initiating investments early on. Lastly, the third category, while potentially rewarding, carries the highest level of risk. Historically, this category encompassed international investments, a strategy rooted in the belief that diversifying into non-US companies could capitalize on global market opportunities. However, in today's context, with the proliferation of the internet and globalized commerce, the rationale for international investment has diminished significantly. Unlike in the 1990s, when international markets offered untapped potential, the landscape has shifted, making it less imperative to allocate a portion of one's portfolio to non-US entities. However, this approach carried significant risk, as these companies were typically smaller and unproven compared to their US counterparts. In 2024, the global business landscape has undergone substantial transformation. With the advent of the internet and enhanced logistics, conducting business across borders has become effortless. Globalization has reshaped the business paradigm, empowering the largest, most robust companies to dominate markets worldwide. Corporations like Apple, Nike, Johnson & Johnson, and Starbucks have established a ubiquitous presence transcending geographical boundaries. Therefore, allocating investments internationally solely based on non-US exposure no longer holds merit. Instead, it's prudent to invest in the most prominent and resilient companies. Examining the empirical data reveals the underwhelming performance of international ETFs like VIXIS, which has only appreciated by an average of 4–6% annually over the past decade. This performance is notably lackluster, considering the inherent risk associated with international investments. Conversely, alternative options boast significantly higher returns, averaging 18–36% annually over the same period and displaying robust projected growth. In lieu of international exposure, the new 3-fund portfolio introduces a growth ETF category. BZ specializes in holding technologically advanced companies poised for accelerated growth. Such companies include industry leaders like Nvidia, Meta, Amazon, semiconductor firms, and AI companies. Among the preferred growth ETFs are VUG from Vanguard, SCG from Schwab, QQQM from Invesco, and MGK from Vanguard. QQQM stands out as a top choice due to its lower fee and inclusion of prominent companies like Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, and Google. Similar to the dividend category, where chasing the highest yield is cautioned against, investors should exercise discretion in selecting growth ETFs. While ETFs focused on AI and semiconductors may exhibit staggering annual appreciations of 20%, 30%, or even 50%, sustainability remains uncertain. Hence, prioritizing ETFs with a proven track record and longevity aligns with the ethos of long-term, straightforward investing. Regarding portfolio allocation, personal strategy and goals should dictate investment decisions. Investors seeking rapid wealth accumulation may tilt towards a heavier allocation in growth ETFs, while those prioritizing cash flow and safety may favor dividend ETFs. As for the speaker's personal portfolio, with approximately 30 years until retirement, a balanced approach is maintained, with 1/3 of the portfolio allocated to each category.